Let's continue on where we left off in part 1. We previously discussed liquidity and asset management ratios. Let's finish by talking about debt management, profitability, and market value ratios. Debt management ratios are going to examine how the company got their funding and will look into their ability to repay what they owe. You can imagine banks and lenders being particularly interested in this set of ratios. Here are a few common debt management ratios that are used. The first 4 present the same basic information, just in different formats. Remember how the balance sheet represents the use of funds and the source of funds? Well, these ratios are going to look at the second part, the source of funds, which will either be debt or equity. How much of the company's funding is coming from each source? For example, the debt to equity ratio. The company is getting money from one of those sources. What are the relative amounts? Do they have more debt, or do they fund themselves primarily with equity? A higher debt to equity ratio implies that the firm is using more and more debt. Similarly, we have the debt to total capital ratio. Instead of looking at debt as a percentage of equity, we're going to look at how much debt they have relative to all the capital they've raised. That is debt and equity combined. So the same information is presented here as the debt to equity ratio. It's just presented in a slightly different format. Again, a higher debt to total capital ratio implies that the firm is using more and more debt. Total liabilities to equity expands the concept of sources of funds a little bit. Instead of viewing borrowing just in terms of long-term debt, we're going to include all the company's liabilities, the current and long-term liabilities. But the main interpretation that we got from the debt to equity ratio and the debt to capital ratio still applies here. A higher total liabilities to equity ratio implies that the company is relying more and more on borrowing to fund their business. Finally, we have the equity multiplier, which is the ratio of total assets to total equity. The equity multiplier tells us, out of all the assets we possess, how much of them were purchased using equity. As this ratio increases, that suggests the company is using more and more debt. Picture the equity multiplier being $10 last year. That means for every $10 in assets we have, $1 of equity was put forth to purchase them. Now, imagine the equity multiplier jumping to 100 this year. That would imply for every $100 in assets, $1 of equity was put forth to purchase them. So what had to have happened between last year and this year? Well, we have a lot more assets, but the same amount of equity. That means debt must have been used to purchase those assets and add them to our balance sheet. The final ratio here is times interest earned, which is computed as earnings before interest and taxes, that's EBIT, over interest expenses. This ratio is going to tell us how the company is able to pay off its required interest payments. Are they barely making enough operating profit to make its interest payments, or do they have a lot of cushion? Picture this ratio being equal to 1. That would mean operating profit is equal to interest expenses. If that was the case, every single dollar of operating profit is dedicated to paying interest on their debt. This isn't a very comfortable position to be in. Instead, if this ratio was very large, a big EBIT and a small interest expense, then paying off interest wouldn't be a concern. We could pay off our interest expenses relatively easily. Now let's look at how E Corp is doing with their debt management. About 20% of their total capital raised comes from debt. And their times interest earned is 6.28. That means they have 6.28 times more operating profit than they do interest expenses. Looking at the trends at the bottom, we can see that the debt to capital ratio dropped substantially between 2017 and 2018. What could have caused that? Well, to make that ratio smaller, either debt had to have decreased or equity had to increase. A deeper dive into the financial statements would help us determine which of these is the case. The next set of ratios to examine are profitability ratios. These will tell us how efficient the company is in generating profits. Within this set, we have 2 groups. The first 3 here can be considered profit margin ratios, and the final 3 can be considered return ratios. Each are going to tell us in some shape or form how effective the company is in turning profits. Let's start with the profit margin ratios. Each of these 3 ratios all have the same denominator, sales. They differ in terms of their numerators, which is some form of profit. The gross profit margin looks at the ratio of gross profit, that is sales minus cost of goods sold, to sales. In other words, this ratio tells us how much of our sales revenue turns into gross profit. For example, if we had a gross profit margin of 50%, so 0.5 over 1, that would mean for every dollar of sales we make, 50 cents of that will turn into gross profit. Operating profit margin takes gross profit and deducts additional expenses. Specifically, we take out administrative and depreciation expenses to get to EBIT. The interpretation of operating profit margin is identical. If we had an operating profit margin of 25%, so that's 0.25 over 1, that implies for every dollar of sales we make, 25 cents of that will turn into operating profit. Lastly, we have net profit margin. We deduct additional expenses from operating profit. We take out interest expense and tax expense, and that gets us to net income. So if we had a net profit margin of 10%, that's 0.1 over 1, that means for every dollar of sales we make, 10 cents of that will turn into net income. For each of these, a larger number would be desirable. That would indicate that we're becoming more efficient. We would be doing a better job keeping our costs in control and generating more profits from our sales. For the return ratios, we have return on assets and return on equity. Again, the numerator on both of these is the same. It's net income. However, for return on assets, we're looking at how efficiently the company is using its assets to generate profits, whereas return on equity, we're looking at how efficiently the company is using equity to generate profits. A larger number for both of these ratios is typically better. For example, imagine return on assets increasing from 0.2 over 1 to 0.4 over 1. That would mean that using the same number of assets, the same machines, the same factories, the company is able to generate more profits. That's a desirable situation to have. Now let's look at E Corp. They have a gross profit margin of 17.6%. So 17.6% of their sales revenue turns into gross profit. 7.1% of their sales turn into operating profit, and 3.6% of their sales turn into net income. Comparing 2018 to their industry peers, they seem to be right in line, and they appear to be on an upward trajectory in terms of profitability. Next, we have E Corp's return ratios, ROA and ROE. For every dollar of assets E Corp has, they're able to generate 7.2 cents of net income. And similarly, for every dollar of equity invested, they're able to generate 12.8 cents of net income. ROE, return on equity, is of particular interest because it represents what the company is doing with the equity that owners have given to them. It's so interesting that I think it's worth spending a little time analyzing it further. We might want to know what aspect of the business is driving changes that we see in return on equity. Is the return to the owner's investment driven by the business's profitability or how they're managing their assets? Or is it due to changes in their debt usage? Determining which part of the business is harming or boosting performance can be helpful in diagnosing trouble areas. This is where DuPont analysis comes in handy. DuPont analysis decomposes return on equity into three components related to areas we've already discussed. DuPont analysis says return on equity equals net profit margin times total asset turnover times the equity multiplier. So we can see ROE has a profitability component, that's net profit margin, an asset management component, that's total asset turnover, and a component related to debt management, that's the equity multiplier. How do we end up with that equation? Well, it's just some simple and clever math. Let's start with the DuPont equation. Return on equity equals net profit margin times total asset turnover times equity multiplier. Let's prove that's true. We'll start by defining the ratios. Return on equity equals net income over total equity. Net profit margin equals net income over sales. And total asset turnover equals sales over total assets, and equity multiplier equals total assets over equity. Now let's start canceling terms. Since sales appears both in the numerator and the denominator, we can cancel them out. Similarly, total assets appears both in the numerator and denominator, so we can cancel those out. So we're left with net income up top and total equity on the bottom. And what does that equal? Return on equity. We can look at this example of Dell to see how DuPont analysis could be useful. Looking at the return on equity over time, we see a steady decline from 2007 to 2009. What was causing this? By doing DuPont analysis, we can answer that question. The bottom line in the second graph is total asset turnover, and it was pretty stable throughout. So poorer asset management probably isn't the culprit. The equity multiplier is declining, meaning we're using less debt, and that could be related to the decline in ROE, but it's not that sharp. It's not a very sharp drop. It really looks like net profit margin is the driver of the decline in return on equity. The shape of that line almost mirrors what we see in ROE. So the reason for the decline in return on equity is likely due to decreasing profitability. The final group of ratios we're going to cover here are called market value ratios. These are interesting because we're going to look a little bit outside of the financial statements to see what real investors think about the business. There's two major ratios in this category, and they're price to earnings ratio, that's the PE ratio, and market to book, MB. The price to earnings ratio will tell us how much investors are willing to pay for $1 of the company's earnings. And is computed by taking the price per share of a stock and dividing by the company's earnings per share. As this number increases, it implies that investors are willing to pay more and more for $1 of this company's earnings. Why would investors be willing to do this? Well, remember that when you buy a company stock, you don't just own the company's current earnings. You own the earnings for the life of the company. So a higher PE ratio can mean that investors are optimistic about the future of the company. Earnings may be lower now, but they expect them to increase in the future. So investors are willing to pay more now. The same logic follows for the market to book ratio, which is computed as the market value per share of the company's equity, that's just the stock price, over the book value of equity per share. Higher values of market to book imply that investors are more and more optimistic about the future of the company. Thus, they're willing to pay more for the same amount of equity ownership. We can see a few sample companies to get a feel for why they might have a high PE ratio or MB ratio. Tesla's ratios are astronomically high. Why is that the case? Well, they have very little earnings currently, but the stock price is skyrocketing. That means investors are very optimistic about Tesla's prospects. Earnings may be low today, but they expect them to be large in the future. I want to wrap up by discussing some of the issues or limitations that come with using ratio analysis. As I mentioned a few times, ratios have to be put into context. A single ratio by itself provides very little information. It only adds value when compared to something else. So try to avoid saying that a particular number is just good or bad. It's all relative. They're either good or bad relative to their peers, for example. Second, while it's useful to compare the performance of a company against that of its industry competitors, oftentimes it's easier said than done. It could be hard to even put some companies into a particular industry. Apple, for example. What are they? Are they a phone company? A music company? A computer company? Each of these are completely different industries, and even if you're able to pin them down to a particular industry, it may be difficult to identify which companies are relevant for comparison. So all of this is a challenge which requires some serious thought. Lastly, I want you to know that sometimes trends do break. So you have to be careful in identifying patterns in ratios. Just because you see a dramatic spike in some aspect of the business does not mean it's going to continue that way in the future. It's important to look into the context of what caused the changes to understand whether it's a one-time blip in the ratio or if it's a long-term fundamental change. I want to end our discussion on financial analysis by moving away from quantitative analysis and looking beyond ratios. We can also analyze qualitative factors of a business. Some qualitative factors could be identifying if the business is tied to just one supplier or not, or if they do business in unstable countries, or maybe if the demographic group for their product is growing or shrinking. Understanding this could give insights into the amount of risk that the company is exposed to. Looking into the competitive and legal environment surrounding the company can also provide information that ratio analysis will miss. Where can we find this information? You can start with the annual report. Typically, they go into great detail on all the issues the company faces. Industry trade groups like the Alliance of Automobile Manufacturers or the American Beverage Association can provide key industry-related information. And government sources like the Federal Trade Commission or the Census can provide useful resources as well. We've covered a lot in this section, but I want to emphasize that memorization is not the objective here. Understanding and interpretation is. So play around with these ratios. Try to interpret what it means if something changes. Maybe pull up the financial statements of your favorite company and analyze them. With practice, this interpretation is going to become like second nature.